Thank you, Ronak. So today is the fourth lecture of the virtual lecture series for even semester, 6 semester students. And today's lecture will be on cash flow statement, our topic of the corporate financial statement and reporting, that particular subject. There for that particular paper, this is a very important topic, and the topic is cash flow statement. So, first of all, I would like to give an introductory lecture on the cash flow statement, what cash flow statement is all about, how that is to be prepared, what is the relevant Indian accounting standard, and what does that Indian accounting standard summarizes about states about the cash flow statement of cash flows, and then we will also solve a couple of illustrations on cash flow statement so that the students, the 6 semester students, can get a better understanding of how to solve practical problems on cash flow statement. So, without wasting any time, I would like to share my slide. Is the slide visible?
No, sir.
Okay, then let me share it once again. Now, is the slide visible?
Yes, sir. Visible.
So, this is about the cash flow statement. Now, the very term cash flow statement, it actually comprises of three terms. We have cash, we have flow, and we have statement. There are the three terms. The first term is the cash, second term is the flow, and the third term is the statement. That means it is a statement, of course, it is a financial statement which deals with the flow of cash. That means there will be some inflow of cash and outflow of cash, and the statement which deals with this inflow and outflow of cash for a particular period of time, that is known as the cash flow statement. So cash cash means all cash and cash equitable, marketable securities and bank balance. That is anything which can be readily converted into cash comes under the purview of cash. So it does not only mean that the cash we have in a hand at a particular point of time, but also the cash we keep in bank, that is the bank accounts, the term deposits and the savings deposits, current deposits that we keep in bank, which can be readily converted into cash. The paper currency, check, demand draft, etc. are all included in cash, as well as certain marketable securities and cash equitables, which can be readily converted into cash. So those come under the purview of cash. That means cash as well as cash equivalents is the subject matter of the cash flow statement. Now, flow just like a river flows, the water flows from one point to the other point. Similarly, cash will also flow from one point to the other point by means of certain transactions. That means certain assets will be transformed into cash, and it will again be transformed into certain other assets or liabilities, and the process goes on. So this is the flow. Flow means that there will be certain inflow of cash and there will be certain outflow of cash. It means the flow of cash from business to economy and economy to business, that is cash inflows and cash outflows. And statement means a financial statement. This is actually a statement of change in financial position. Financial position, that is the cash position, will be changed, is being changed over a particular period of time, and it is a financial statement. So this is cash flow statement is a type of a financial statement which shows the change in the cash position, cash balance from the opening date of the balance sheet to the closing date of the balance sheet. So simply speaking, cash flow statement is a statement of inflows, that is the sources of cash, and outflows, that is the uses of cash and cash equivalents in an enterprise during a specified period of time. So cash flow statement summarizes the causes of changes in cash position of a business enterprises between dates of two balance sheets. That means in the opening date of balance sheet, what is the cash position of a particular business or a particular enterprise, and what is the at the end of the particular year, that is the end of the financial year, that is the closing date, what is the cash position of a particular business enterprise. So how this cash position has changed, what are the various causes, what are the various sources of cash inflow, and what are the various applications of cash, that is the what are the various cash outflows, when they are all summarized in a particular statement, that is known as the cash flow statement. So a statement of cash flow reveals the movements of cash of a business enterprise for the given accounting period, indicating specifically how the cash was generated. It is generally required for short range financial planning. That is a budget or a financial planning for 1 or 2 years or maximum of 5 years. Then cash flow statement is very helpful because we project the cash flow statement, what are going to be the various cash inflows in future and what are the various cash outflows that will arise in the future, and then how what will be the cash position during that particular period of time, that is determined and projected, and this technique helps in financial planning. So it actually reveals the movements of cash, that is the cash inflows and cash outflows from the viewpoint of a business enterprise for a particular given accounting period. Now, as per Accounting Standard 3, nowadays Indian Accounting Standard 7, statement of cash flows has been implemented, already been implemented, and that is being followed. I will discuss it about it in detail later on. So, as per this Accounting Standard 3 and now the Indian Accounting Standard 7, statement of cash flows, the changes resulting in cash inflows and cash outflows arise on account of three types of activities. One, the first one is the operating activities. Operating activities is the basic activities which occur day to day in a business enterprise. They are occur these activities occur due to the business operations of business enterprise from in a day to day manner. So operating activities are the principal revenue generating activities of the enterprise and other activities that are not investing and financing activities. These are the results of those transactions and events that determines the net profit or loss, like cash receipts from the sale of goods and the rendering of services, cash receipts from royalties, fees, commissions, and other revenues, cash payments to suppliers of goods and services, cash payments to and on behalf of employees, cash receipts and cash payments of an insurance enterprise for premiums and claims, annuities, and other policy benefits, cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities. So, in a nutshell, operating activities are those activities which deal with the day-to-day business operation. Day-to-day business operation, for day-to-day business operation, we require certain purchase of materials. We require we have to pay wages and salaries to the employees. We have to buy certain items. We have to pay for operating expenses. So all those activities which are which occur or arise due to the day-to-day business operations of a firm. So when related to those activities, cash is either paid or cash is either received. That means there may be either cash outflow or cash inflow. So when cash inflow or outflow arises due to these operating activities like the sale of goods or receipts from royalties, fees, commissions, payment made to suppliers of goods and services, purchases of goods, operating expenses, payments towards the employees, that is the wages and salaries paid, receipts and payments in the form of insurance claim, annuities and other policy benefits, payment of income taxes, refund of income taxes, all these come under the purview of operating activities. So cash inflow or outflow arising from all these operating activities are the cash flows from operating activities. Next, we have cash flow from investing activities. Investing activities include the acquisition and disposal of long-term assets and other investments not included in cash equivalents. So investing activities means we are investing in certain assets, fixed assets, that is the long-term assets, or we are acquiring those assets, or we are selling off, that is disposing those assets. So whenever any purchase of land, building, plant, machinery, or sale of land, building, plant, machinery, or say investment in certain securities of a particular company, or disinvestment, that is redemption of those securities, sorry, disinvestment, that means the invested securities have been sold. So all those activities which revolve around the investment of a particular business enterprise related to the acquisition of fixed assets, long term assets, or investments, or disposal of those long term assets and investments not included in cash equivalents, they come under the purview of cash flow from investing activities. It is generally by the asset side of the balance sheet. By looking at the asset side of the balance sheet, we can identify the various investing activities. Asset side has both the fixed assets, that is the long term assets, as well as the investments. So if those long term assets or investments are acquired, or if those are sold, then those come under the purview of the investing activities. Now, similarly, if interest is received from any investment, or dividend is received from any investment in shares, we receive the dividend, or investment by the means of loans, we receive interest. So if interest is received or dividend is received due to the investment made by an enterprise, that will also come under the purview of the investing activities. So various cash flows, cash inflows or cash outflows that arises from the investing activities come under the purview of cash flow from investing activities. So examples are cash payments to acquire fixed assets, including intangibles, and cash receipts from disposal of fixed assets, including intangibles. They come under the purview of this cash flow from investing activities. Then again, we have cash payments which are made to acquire, and cash receipts from disposal of shares, warrants, or debt instruments of other enterprises and interests in joint ventures, or cash advances and loans made to third parties, or say cash payments and receipts for future contracts, forward contracts, option contracts, swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. Except these particular exceptions, whatever cash payments and receipts made for various forwards, futures, options, and swaps, they also come under the purview of the investing activities. So investments in not only the long term assets, fixed assets, or disposal of long term assets, fixed assets, but also the investment in various securities, financial securities, and disposal thereof also come under the purview of the investment activities of a business firm. So that is the business is investing its funds in either the long term assets or certain investments. And when those investments are sold, or long term assets are sold or disposed of, then also there is certain cash inflow. So this cash outflow and cash inflow due to the various investing activities of a business enterprise all come under the purview of cash flows from investing activities. Now we will discuss about the cash flow from financing activities. Cash flow from financing activities. Now cash flow which arises from financing activities can be easily ascertained by looking at the liability side of the balance sheet. Liability side of the balance sheet deals with the various long term sources of finance. Long term sources of finance like the equity shares, debentures, preference shares, long term loans, any other type of loans from various financial institutions, or say any government grant. All those are the various types of sources of finance for a particular business enterprise. So cash flow from financing activities arises from various finance, how the finance is made by a business enterprise, whether by issue of shares, issue of debentures, or say raising long term loan, issue of preference shares. So all these come under the purview of cash flow from financing activities. Separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims of future cash flows by providers of funds, both capital and loan, to the enterprise. Financing activities are activities that result in changes in the size and composition of the owner's capital, including preference share capital in the case of a company and borrowings of the enterprise. Am I audible?
Yes, sir.
Okay. So financing activities, it deals with the finances of a particular business enterprise, activities which result in either the increase of the finance, that is in raising of the finance, or disposing of that finance. That means either it will be cash inflow will be generated due to the issue of equity shares, issue of preference shares, due to the redemption of redemption of debentures, redemption of preference shares, buyback of equity shares, or interest paid, dividend paid due to the finances for interest paid for loans, dividend paid for the equity shares. So all these are the various types of financing activities, and cash inflow or outflow may arise due to these financing activities. So broadly, these activities are distinguished, classified into three categories: operating activities, investing activities, and financing activities. Certain examples of financing activities like cash proceeds from issuing shares or other similar instruments, cash proceeds from issuing debentures, loans, notes, bonds, and other short or long-term borrowings, and cash repayments of amounts borrowed, such as redemption of debentures, bonds, preference shares. Now, cash flows arises from uh, three major activities which have been identified as per the INDES statement of cash flows and the earlier AS3, that is the cash flow statement. Three major activities of business firm, that is the operating activities, investing activities, financing activities. And as such, when we will prepare the cash flow statement, we will have to prepare it in three stages. In the first stage, we will have to show the cash flows from the operating activities. In the second stage, we will have to show the cash flow from the investing activities. And in the third stage, we will have to show the cash flows from the financing activities. Now, cash flow statement may be prepared either through direct method or through indirect method. That I will illustrate when I will be solving the problems. Illustrate um, uh, both the direct method and the indirect method. But generally, the format of cash flow statement is as follows, given here in this particular slide. That is, first of all, we determine the cash flows from the operating activities. To determine that, we will be given certain net profit. That means net profit before tax and extraordinary items, that will be given in the particular problem. That will be revealed in the profit and loss. From the profit and loss account, we can easily ascertain what is the net profit before tax and extraordinary items. With this particular net profit, we will have to make certain adjustments. That means we will have to add back the various non-operating profit. Operating profit, that is the non which do not relate to the operating activities of the business enterprise, and those for which any cash has not been expended, like the paper transaction, like depreciation, amortization. It is actually a paper transaction. No cash is expended, no cash outflow arises due to those sort of transactions, and those sort of transactions and non-operating expenses will have to be added back. So adjustments like depreciation and amortization, provision for doubtful debts, foreign exchange gain or loss, dividend, interest, which actually are the purview, comes under the purview of the financing activities. So these sort of adjustments have to be made. They have to be added or deducted as per the nature of the problem. Gains or losses, loss on sale of fixed assets and investments, these sort of adjustments have to be made with the net profit before tax and extraordinary items. After these adjustments, what we get is the operating profit before working capital changes. So along with this, we have to we after we derive this operating profit before working capital changes, we will have to make certain adjustments for working capital changes. That means the working capital maybe deals has two aspects: current assets and the current liabilities. So if there is an increase in the current assets or decrease in the current assets, what will be its impact on the cash flow statement? or if there is an increase in the current liability or decrease in the current liability, what will be its impact on the cash flow statement, that we will have to determine, and similarly we will have to make the adjustments. Now there is a thumb rule for calculating whether the what is the impact of the increase in the cash flow of the current assets on the cash flow statement or decrease in current assets on the cash flow statement. There is a particular thumb rule, that is there is a negative relationship. If the current assets increases, cash flows will decrease, and if the current assets decrease, cash flow will increase. How? Suppose goods have been sold for cash. That means cash account debit to sales account. Now, in place of cash, if we sell the goods through credit, then it will be debtor account debit to sales account. So instead of receiving cash, we are increasing the debtors. Debtors balance has increased, but the cash has not been received by the business enterprise. So increase in current asset actually results in the decrease in the cash flow. That means the cash has not been received since the current assets has increased. Similarly, when current assets decreases, cash increases. Because suppose the debtors have repaid, that means debtors account debit to cash account debit to debtors account. Debtors have already repaid their debt to the particular firm. We have received the collection from the debtors in cash. That means debtors account debit to cash account. So since we have received the collection, cash account debit to debtors account. Since we have received the collection from the debtors, cash is coming into the business, so cash account debited, and the debtors balance is decreasing, cash account debit to debtors account. So whenever the current assets decreases, cash balance increases. So there is a negative relationship between the current assets and the cash balance. If there is an increase in the current assets, then it will lead to decrease in the cash balance, and if there is a decrease in the current assets, then it will lead to a rise in the current cash balance. This is the rule. Similarly, for the current liabilities also, there is a thumb rule, that is there is a direct relationship between current liabilities and the cash balance. Suppose goods have been purchased on credit, so purchase account debit to creditor account, and if we purchase the goods on cash, it will be purchase account debit to cash account. Since we are purchasing it on credit, we do not have to expend any cash. That means there is no cash outflow since the goods are being purchased on credit. So that means increase in current liability leads to increase in cash balance, because we do not have to expend any cash since we are increasing our current liability. So increase in current liability leads to increase in cash, and decrease in current liability leads to decrease in cash. That will be explained later on when I will be solving the problems. So these sort of adjustment for changes in working capital have to be made with the operating profit before working capital changes, and then what we derive is the cash generated from operations. From that cash generated from operations, we deduct the income tax paid, and if any other extraordinary items, that has to be adjusted, and what we receive at the end of this is the net cash flow from operating activities. So in this way, this cash flow from operating activities is derived. We arrive at the result of cash flow from operating activities. Next, cash flow from investing activities. Cash flow from investing activities, while preparing this particular second aspect of this cash flow statement, we will have to be very careful, because generally cash flow from investing activities result in a negative figure, because our investment into the business, what we are investing into the business, that is the cash outflow. Whenever we are investing into the business, there is going to be certain cash outflow. Cash outflow generally exceeds the cash inflow, and as a result, the cash flow from investing activities is generally a negative balance. Here, from cash flow from investing activities, we may have purchase of fixed assets, we may have purchase proceeds from sale of fixed assets, we may have investments, acquisition of investments, purchase of investments, proceeds from sale of investments, interest received, dividend received, and so on. If the cash outflow, that is the purchase of fixed assets or purchase of investments, exceed the proceeds from sale of fixed assets, proceeds from sale of investments, or interest received, dividend received, Then if the cash outflow exceeds the cash inflow, we will get a negative result, and that will be the cash flow from the investing activities. So whatever is the inflow, we will write it, and whatever is the outflow, we will write it within brackets, and then we will derive the cash flow from the investing activities. If it is a positive balance, it will be added, and if it is a negative balance, that will be deducted from the positive balances. So this is how the cash flow from investing activities is asserted. And after that, we have to calculate the cash flow from the financing activities. For that, we will have to um, analyze the liability side of the balance sheet, whether there is any cash inflow or outflow from the various types of financing activities. So various types of financing activities like the proceeds from issue of shares and debentures, it is a cash inflow. Proceeds from long-term debts, again it is a cash inflow. Repayment of long-term debts, that is the cash outflow. Redemption of debentures, redemption of preference shares, those are cash outflow. Dividend paid, interest paid, those are all cash outflow. So whenever there is any issue of equity share, issue of preference share, issue of debentures, or raising of long-term loan or proceeds from long-term loan, those are all cash inflows. And from those cash inflows, various types of cash outflows like the repayment of long-term debts, redemption of debentures, redemption of preference shares, dividend paid, interest paid, etc., will have to be deducted. And then if there is any positive balance, that will be added, and if there is any negative balance, that will be shown within bracket, and that will be deducted from the positive balances. So after we obtain the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities, we simply make an aggregate of the three, a plus b plus c. Whatever negative will be deducted, and whatever is the positive balances, that will be added, and the summary will be the net cash flow from the entire operating, financing, and investing activities, and we will get a result. It will be either an increase or a decrease, net increase or decrease in cash and cash equivalents. That is the net cash flow. We will get the net cash flow, that is the net increase or decrease in cash and cash equivalents, a plus b plus c. Now with this, if we add the cash and cash equivalents at the beginning of the year, we will obtain the result cash and cash equivalents at the end of the year. This is simply the format of the cash flow statement. I will illustrate, I will explain it more clearly if I will be showing, when I will be showing the illustrations. But before we move on to the next topic, I will have to discuss about the Ind AS 7 statement of cash flows. I will have to discuss about it. So Ind AS 7 statement of cash flows, whenever we are going to prepare this cash flow statement, we will have to be very careful. We will have to prepare this cash flow statement as per the Indian accounting standard 7 statement of cash flows. This India 7 has been issued by the Institute of Chartered Accountants of India, and all the companies, listed companies, and the companies which prepare statement of cash flows as per their provisions, legal provisions, will have to comply with this Ind AS 7 statement of cash flows. Now let us know what is the objective of this particular standard. The objective is to require the provision of information about the historical changes in cash and cash equivalents of an entity by means of a statement of cash flows which classifies cash flows during the period from operating, investing, and financing activities. That means, simply speaking, it is this standard deals with certain provision of information. That means certain provision of information, certain information has to be provided about the historical changes in cash and cash equivalents of an entity. What is the change? What is the change in cash and cash equivalent of a particular entity by means of a statement? That means a statement has to be prepared which will provide information about the historical changes in cash and cash equivalents of an entity during a particular period arising from operating, investing, and financing activities. So this is the main objective of this standard. And then what is the scope of this standard? This scope states that an entity shall prepare a statement of cash flows in accordance with the requirements of the standard and shall present it as an integral part of its financial statements for each period for which financial statements are presented. That means it will not only prepare this cash flow statement as per the provisions mentioned in the standard, but it will also, the enterprise will also have to present it as a part, as an integral part of his financial statements. Integral part of his financial statements, that is along with the profit and loss account, that is the income statement or balance sheet, that is the statement of financial position. It will also have to show the statement of cash flows. The cash flow statement, it will also have to present the statement of cash flows. So this is the actually provision required as per the, according to this standard. This is mandatory. Cash flow statement preparation is mandatory for all those accounting enterprises, for all the enterprises for which cash flow statement is required. This statement of cash flows, when used in conjunction with the rest of the financial statements, provides information that enables users to evaluate the changes in net assets of an entity, its financial structure, including its liability and solvency, and its ability to affect the amounts and timing of cash flows in order to adapt to changing circumstances and opportunities. This cash flow information is again useful in assessing the ability of an enterprise to generate cash and cash equivalents, and enables users to develop models to assess and compare the present value of the future cash flows of different entities. It also enhances the comparability of the reporting of operating performance by different entities because it eliminates the effects of using different accounting treatments for the same transactions and events. That means these are the various objectives of this cash flow statement. That means this cash flow statement will provide information which will enable the user to evaluate the changes in net assets of an entity. What is the impact of change in cash flow statement on the net assets of an entity, its financial structure, and its ability to affect the amounts and timings of cash flows, whether it will be able to adapt to its changing circumstances and opportunities or not. All these information are provided through the statement of cash flows. Then again, this statement of cash flow will also be useful in assessing the ability of the entity to generate cash and cash equivalents, which will enable the users to develop models to assess and compare the present value of the future cash flows of different entities. That means their comparison may be made between one firm and the other firm. Inter-firm comparability can be done through this cash flow information. Furthermore, it also enhances the comparability of the reporting of an operating performance by different entities because it eliminates the effects of using different accounting treatments for the same transactions and events. There may be certain non-cash transactions, certain paper transactions. So all those non-cash transactions, paper transactions will be eliminated, and the focus will be made on the cash profit. That is the cash operating profit, and whether the cash operating profit has, how much that cash operating profit has been generated during a particular period. Comparison may be made between the firms, and which firm is efficient, which firm is more efficient, that can be determined. So this is generally the motive of the preparation of cash flow statement, the purpose of preparation of cash flow statement as per the Indian Accounting Standard 7. Now I will be focusing on the practical aspect of cash flow statement, how this cash flow statement problems on cash flow statement has to be solved. So theoretical, I have given the theoretical background. Now I will be focusing on the practical aspect. So what we have learned from the theoretical background is that the cash flow statement, what cash flow statement is all about, it is actually a statement, a financial statement, which shows the changes in the cash position of a particular business enterprise, that is the cash inflow and cash outflow of a business enterprise arising from operating activities, investing activities, and financing activities during a particular accounting period. So that is the cash flow statement. How this cash flow statement is prepared, or what are the objects of this cash flow statement, what is the format of cash flow statement, what are the various activities that have been discussed in detail in the theoretical part. Now we will focus on the practical part. Now, before we move on to the practical part, let us reiterate, let us just look at these differences between the fund flow statement and cash flow statement. Let us know the difference between the cash flow statement and the fund flow statement. Now, cash flow statement is generally deals with the cash and cash equivalents, and fund flow statement deals with the fund, that is the working capital fund of a business enterprise. So fund flow statement depicts how the financial position of the firm is affected by the different activities of the firm in terms of fund. And cash flow statement deals with the to show how the different activities of the firm alter its financial position in terms of cash and cash equivalents only. So fund flow statement, it shows the changes in the operating capital, working capital, that is the how this fund is generated and how that fund is utilized. And cash flow statement mainly deals with how this cash is generated, cash flows are generated, cash inflow and cash outflow are generated from the various types of activities of a business firm. Now, fund has been interpreted in a several manner. It may be either literal cash, short-term monetary assets, net working capital, or all financial resources concept. But so far as cash flow statement is concerned, as per Accounting Standard 3 or the Ind AS 7, the definition of cash and cash equivalents has been clearly stated, and there cannot be any alternative interpretation. Now, this fund flow statement, the basis of fund flow statement is operating basis of accrual basis of accounting, and the cash flow statement is the cash basis of accounting. So, fund flow statement does not deal with what has been received in cash, the actual cash receipts or the actual cash payments, but what should be the actual expenses, what should be the income for a particular accounting period for a particular 12 months. That is the subject matter of the fund flow statement. That means it is based on the accrual basis of accounting. Pre-received income, prepaid expenses, income received in advance, or expenses paid in advance, etc., are all included under the fund flow statement. But under the cash flow statement, actual cash receipts and actual cash payments only are to be considered. That means actual cash inflow and actual cash outflow, not what should be, but what has been. What has been paid, what has been expended, what has been received, what revenue has been generated in terms of cash flow. That is the subject matter of cash flow statement. So it deals with the cash basis of accounting. In fund flow statement, there is a supplementary statement known as the which shows the changes in current assets and current liabilities of a particular year. But in case of cash flow statement, there is no supplementary statement. Now, information disclosed through the fund flow statement, it depicts the various sources from which funds are generated, the various uses to which they are put, and the net increase or decrease in working capital during a particular period. But so far as cash flow statement is concerned, it discloses the net cash flows from operating activities, investing activities, and financing activities separately, and the net increase or decrease in cash and cash equivalents. That is the subject matter of the cash flow statement. Now, fund flow statement may be used for intermediate and long range financial planning, and cash flow statement is mainly used for both for short term and long term financial planning. Now, we will focus on the practical aspect of the cash flow statement. We will solve certain practical sums. So, let us focus on this first sum. Here, this is a sum which has to be solved under the direct method, because all the cash receipts and the cash payments, that is the cash inflows and cash outflows, are already stated in this particular problem. In this problem, it is stated here that from the following summary, cash account of X Limited prepare cash flow statement for the year 31st March 2021 in accordance with Ind AS 7 using the direct method. So a particular cash account is given and we have to prepare a cash flow statement using the direct method. Now in the direct method, all the cash inflows and cash outflows arising from various types of activities are already stated, already given, and we have to only arrive at the cash flow statement, that is the cash flow from operating activities, by the following manner. That means, first of all, we will write all the activities, the cash inflows arising from the operating activities. We will deduct the cash outflows from operating activities, and we will get the net cash flow from operating activities. Similarly, for cash flow from investing activities, we will first of all write the cash inflows from the investing activities. From that, we will deduct the cash outflows from investing activities, and we will get the net cash flow from investing activities. Similarly, for net cash flow from financing activities, we will first of all write various types of cash inflows from the financing activities, and we will deduct the cash outflows from financing activities, and we will get the result net cash flows from financing activities. Then we will add net cash flows from operating activities, net cash flows from investing activities, net cash flows from financing activities, and we will get the net increase or decrease in cash and cash equivalents. And along with that, we will add the opening balance of the net cash and cash equivalents. And if our answer is correct, if we have solved the problem correctly, then we will arrive at the cash flows, that is the closing cash balance, that is cash and cash equivalents at the end of the year. Now, for the students, it is very important. That means this cash flow statement, you can, while solving the problem, you can readily know whether you have solved the problem correctly or not, because after solving this problem, after generating or ascertaining what is the net cash flow, that is increase or decrease in cash and cash equivalents at the end of the year, you can easily verify whether you have solved the problem correctly or not by adding the opening cash and cash equivalents. If with the net cash flows arising from operating, investing, and financing activities, if the aggregate of these three, along with this, if you add the opening cash and cash equivalents, and if you get the cash and cash equivalents at the end of the year, if it is matched with the cash and cash equivalents at the end of the year matches with that given in the sum, then you will know that you have solved the problem correctly, because this is the only problem where you can ascertain whether you have solved this particular sum correctly or not, by just judging by adding this opening cash and cash equivalents. And if you arise at the closing cash and cash equivalents, then you will know that you have solved the problem correctly. So here in this problem, here you just look at the receipt side of this cash account. In the receipt side, that is the debit side, you will find that there is an opening balance of 50,000, issue of equity shares of 3 lakh, receipts from customers 28 lakh, and sale of fixed assets 1 lakh. So total of 32 lakh 50,000. And in the credit credit side, that is the payment side, you will find that there is a payment to suppliers of 20 lakh, purchase of fixed assets for 2 lakh, overhead expenses of 2 lakh, wages and salaries of 1 lakh, taxation 2 lakh 50,000, dividend 50,000, repayment of bank loan 3 lakh, and closing balance of 1 lakh 50,000. So total of 32 lakh 50,000, that is there is an opening balance of 50,000 and a closing balance of 1 lakh 50,000. So before we embark on this journey of preparation of cash flow statement, we will have to identify which are the operating activities, which of these cash inflows and outflows are the operating activities, which of these cash inflows and outflows are the investing activities, and which of these cash inflows and outflows are the financing activities. So just looking at the receipt side, we will find that receipts from customers, that means there have been some certain cash sales made to the customers, and after that cash has been received from the customers, that is cash inflow has been generated from the receipts from customers. So these come under the purview of the operating activities. So receipts from customers is a cash from operating activities, cash inflow from operating activities. So far as the equity issue of equity shares is concerned, it is a cash inflow arising from the financing activities. So issue of equity shares, cash inflow arising from the financing activities. And sale of fixed assets, since it deals with the fixed assets, so sale of fixed assets means disposal of fixed assets. It is the cash inflow arising from the investing activities. So in the receipt side, we have identified the three activities. Which one is the operating activity? Which one is the investing activity? Which one is the financing activity? Now let us move towards the payment side. That is the credit side. Here you see payments to suppliers for 20 lakh, overhead expense for 2 lakh, wages and salaries for 1 lakh, and taxation of 2 lakh 50,000. These are all operating activities. These are all cash outflows arising from operating activities. Payment to suppliers, day-to-day operations of a business firm. Goods are being purchased from the suppliers, and after that cash is paid to the suppliers. So this is an operating activity. Overhead expense other than the prime cost is known as the overhead. And so overhead expense, any expense overhead, like it may be lighting expense, electricity expense, rent, lighting, electricity, rent, etc. Various types of materials, indirect materials purchased, indirect wages paid, all these are overhead. So all these overhead expense of 2 lakh, these are again the day-to-day operating activities of business firm. Wages and salaries paid, again day-to-day operating activities of business firm. Taxation paid, again day-to-day operating activities of business firm. So these are all cash outflows. So we have identified the cash inflow receipts from customers and the cash outflows, payment to suppliers, overhead expense, wages and salaries, and taxation. So first of all, we will prepare this cash flow from operating activities. So we are stating cash flow statement of X Limited for the period ending 31st March 2021 as per Ind AS 7 direct method. Cash flow from operating activities, receipts from customers 28 lakh, less cash payments under various heads, that is payments to suppliers. Payments to suppliers, you see it's 20 lakh, 20 lakh. Next, overhead expense of 2 lakh, wages and salaries of 1 lakh, and taxation of 2 lakh 50,000. So we have four types of cash outflows, that is cash payments under various heads which arise due to the operating activities. We are adding them 20 lakh, 2 lakh, 1 lakh, and 2 lakh 50,000, and we are getting 25 lakh 50,000. And receipts from customers is 28 lakh. So from 28 lakh we are deducting 25 lakh 50,000, and we are getting the cash flow from operating activities of cash flow from operating activities of 2 lakh 50,000. Now we will focus on the investing activities. Investing activities, here in the debit side, sale of fixed assets of 1 lakh, it is an investing activity. And in the credit side, we have purchase of fixed assets of 2 lakh. So it is again an investing activities. Purchase of fixed assets means cash is going out of the business, so that is the cash outflow 2 lakh, and cash inflow is 1 lakh sale of fixed assets. So we will prepare the cash flow from investing activities. So cash flow from investing activities, sale of fixed assets 1 lakh, less purchase of fixed assets 2 lakh. So we are getting the net cash flow from investing activities, that is a negative balance. So we are showing it within bracket. Within bracket it is 1 lakh. 2 lakh 50,000, that was the net cash flow from operating activities, and net cash flow from investing activities is minus 1 lakh. So 1 lakh is shown within bracket because sale of fixed assets is 1 lakh and purchase of fixed assets is 2 lakh. So the cash outflow is exceeding the cash inflow, and that is why we are obtaining a negative balance, and that is the net cash flow from investing activities. Finally, we will be focusing on the cash flow from financing activities. Now in the receipt side, we have issue of equity shares rupees 3 lakh. Receipts of issue of equity shares rupees 3 lakh, that is the financing activity, cash inflow from financing activity. And in the payment side, we see, if we analyze the payment side, we will find that there is a dividend paid. Now, dividend paid is due to the issue of equity shares. For the equity shareholders, dividend has to be paid. So naturally, it is a cash outflow from financing activities. And again, we have repayment of bank loan. Bank loan is being repaid. Repayment of bank loan 3 lakh. So that is again a financing activities, cash outflow from financing activities. So we have identified cash inflow from financing activities, that is the issue of equity shares 3 lakh. And we have also identified the cash outflows from financing activities, that is dividend paid 50,000 and repayment of bank loan 3 lakh. So now we are simply preparing the cash flow from financing activities, issue of equity shares of 3 lakh and dividend paid, repayment of bank loan, both of which are the cash outflows. They are added 50,000 and 3 lakh, and we get a result of 3 lakh 50,000. And from this 3 lakh, we deduct this 3 lakh 50,000. From this 3 lakh, we deduct this 3 lakh 50,000, and we get the negative result, that is the cash outflow of 50,000. So this is the cash flow from financing activities, negative 50,000, and this negative 50,000 is shown with the bracket. This is the cash outflow. Now finally what we will do, we will add this net cash flow from operating activities 2,50,000, net cash flow from investing activities minus 1 lakh, and net cash flow from financing activities, that is the minus 50,000. So from 2,50,000, this 1,50,000 negative balance will be deducted, and we will get the net cash flow, that is the net increase in cash and cash equivalents, A plus B plus C, that is 1 lakh. So net cash flow, that means the cash and cash equivalence balance has increased by 1 lakh during this particular accounting period. From the opening date of the balance sheet to the closing date of the balance sheet, this net cash flow, that means there has been a net increase in cash and cash equivalents of that particular business firm of rupees 1 lakh during that accounting period. So 1 lakh is the net cash flow. We have ascertained, we have arrived at that particular figure. Now, if we add the opening balance of the opening cash balance, that is the 50,000. So we are adding the opening cash balance of 50,000 with this 1 lakh, and we are getting the closing cash balance of 1 lakh 50,000. Closing cash and cash equivalents of 1 lakh 50,000. So let us just check whether it matches with the problem with the sum or not. The balance as on 31st March 2021 is 1 lakh 50,000. So this is the balance, and after preparing of the cash flow statement, we are also arriving at the same balance, closing cash and cash equivalents 1,50,000. So by solving this problem, we can straight away know and ascertain that our problem has been solved correctly, because the closing opening cash balance, along with this, when we are adding the cash net increase or decrease in cash and cash equivalents during that particular year, we are arriving at the closing cash balance, which is already given in the problem. So in this way, this is a simple sum on cash flow statement under the direct method. So in this way, we can solve the sum under direct method. But generally, problems, university level examinations or examinations in the professional courses, for professional courses in CA, CS or CMA, these type of problems and cash flow statement, generally you will have to solve sums under the indirect method. So more important to you, for the students, is the indirect method, how the we will solve the cash flow statement under the indirect method. So for that also, I will explain it by showing the by solving the sum with the help of a following illustration. Ronak, do I have time for half an hour? Okay, okay. Then I will solve this sum, and I will also explain a few fine points, certain important points regarding this cash flow statement. So first of all, we will just study this particular problem. This is a problem which we will solve under the indirect method. In this problem, opening balance sheet and closing balance sheet, liabilities and assets, opening balance sheet and closing balance sheet. That means two balance sheets are given. 31st March 2020 and 31st March 2021. 31st March 2020 means the opening balance sheet, that is the 1st April 2020, and 31st March 2021 is the closing balance sheet. So balance sheet of Symphony Limited as on 31st March 2020 and 31st March 2021 are given below. And from the following information, you are required to prepare a cash flow statement for the year ended 31st March 2021 as per Ind AS 7. Now, nowadays the balance sheet is prepared, that is the statement of financial position is prepared in a vertical manner. So your problem on cash flow statement, you will find the similar type of problems in a vertical manner. It will be shown in a vertical manner, but for the simplicity, I have shown it in the horizontal manner. So liabilities, here you see the liabilities of the Symphony Limited. It was 5 lakh at the beginning of 1st April 2020. That means the 31st March 2020 it was 5 lakh. Now it has increased to 6 lakh 50,000. Preference share capital, it was 1 lakh and it has decreased to 50,000. General reserve was 2 lakh and it has been increased to 2 lakh 50,000. There has also been an increase of 10,000 capital reserve. 8% debentures, which was 3 lakh and which was it was 3 lakh on as on 31st March 2020, but it has decreased to 2 lakh as on 31st March 2021. So this is the liabilities side, the long term liabilities. So far as the short term liabilities, that is the current liabilities are concerned, there is a creditors for expenses 10,000 to 12,000 and creditors for goods 1,60,000 to 2,50,000. That means that current liabilities has increased by 2,000 and 90,000 respectively. Similarly, there is also a proposed dividend. Proposed dividend was 30,000 as on 31st March 2020, and as on 31st March 2021, proposed dividend is 35,000. Provision for taxation was rupees 70,000 as on 31st March 2020, and as on 31st March 2021, it has increased to 75,000. Now, if we analyze the assets side, we will find that fixed assets less depreciation, fixed assets of 10 lakh and depreciation of 2 lakh, that is the net block is 8 lakh as on 31st March 2020, and fixed assets of 12 lakh and depreciation of 2 lakh 50,000, so net block of 9 lakh 50,000 as on 31st March 2021. Investments given at cost 1,80,000, 1,80,000, it has remained unchanged. So far as the current assets are concerned, non-cash current assets are concerned, that means except the cash, the non-current current assets are concerned, like stock 2 lakh to 2 lakh 50,000, it has increased by 50,000. Debtors, it was 2 lakh 25,000, now it is 2 lakh 65,000, again there is an increase. Bills receivable 38,000 to 62,000, and prepaid expenses from 2,000 as on 31st March 2020 to 5,000 as on 31st March 2021. So all the current assets have increased as well as the current liabilities have increased. So what will be its impact on the cash flow statement? Whenever there is an increase in the current liability, it leads to increase in the cash balance, so we will add them. And whenever there is an increase in the current assets, it actually leads to decrease in the cash balance, so we will deduct them. So that is the impact. Cash balance has remained unchanged from 10,000, 10,000, and miscellaneous expenses, it was 15,000 as on 31st March 2020, and as on 31st March 2021 it is 10,000. So total of the liability side and asset side of the balance sheet as on 31st March 2020 is 14,70,000, and total of the asset side of the balance sheet as on 31st March 2021 is 17,32,000. Now there some additional information is given in this problem. It is stated that during 2020-21, fixed assets, that is book value of 10,000, depreciation return of 30,000, were sold for 8,000. That means certain fixed assets were sold for 8,000, which book value of which was rupees 10,000 and depreciation return of was 30,000. That means the original cost was this 10,000 plus 30,000. The original cost was 40,000. From this 40,000, depreciation has already been written of 30,000, and the book value was 10,000, and it was sold for 8,000. So there was a loss on sale of fixed assets of 2,000. So that we will have to show by preparing a ledger account of these fixed assets. We will prepare a ledger account of these fixed assets, and or we can also prepare a disposal for sale of fixed assets. We can also prepare that particular account also, and we can show how much profit or loss has been generated due to this sale or disposal of fixed assets. Next additional information is the dividend proposed in last year was paid, and taxation liability was settled for rupees 50,000. So in case of proposed dividend, last year's proposed dividend was 30,000 and it was paid during this year. But in case of provision for taxation, last year provision for taxation of rupees 70,000 was made, but out of which taxation liability was settled for rupees 55,000. So that adjustment has to be made, and this will be shown in under the ledger accounts, proposed dividend and provision for taxation respectively. We will have to prepare the ledger accounts of proposed dividend and provision for taxation, fixed assets. We will have to prepare these ledger accounts, and we will get some balancing figure. Similarly, it is a problem also states that during 2021, investments costing rupees 80,000 were sold and investments of the same cost were purchased. That means investing costing rupees 80,000 were sold and investments costing the same were purchased. So we can show it under the investment account, and there may be or may not be any profit involved. So we will just have to show this transaction in the under the investment account. Finally, preference shares were redeemed at 5% premium by issuing new equity shares, and debentures were redeemed at 10% premium. Now, this is an interesting aspect of this particular problem. Problem is not stating how much preference shares were redeemed or how much debentures were redeemed, but it is only stating that preference shares were redeemed at 5% premium by issuing new equity shares. So if we just analyze the balance sheet, we will find here that preference share capital was rupees 1 lakh and it has reduced to 50,000. That means 50,000 preference share capital has been redeemed. And equity share capital has increased by 1,50,000. So in this case, you see issue of equity share is 1,50,000, whereas redemption of preference share capital is only 50,000. That means for 50,000 redemption, there was an issue of 50,000 issue of equity share capital. But again, there was also a redemption of debenture for 1 lakh, 3 lakh to 2 lakh. So for 1 lakh redemption of debenture, there was again an issue of equity share of 1 lakh. That means equity shares have been issued for both redemption of debenture and redemption of preference share capital. Redemption of debenture is 1 lakh and redemption of preference share capital is 50,000. So 1 lakh plus 50,000, 1 lakh 50,000 redemption. And to finance this 1 lakh 50,000 redemption, equity shares have been issued for 1 lakh 50,000. Now we will have to be careful, that is whenever these equity shares are being issued, whether it is being issued at a premium or not, that has to be taken into consideration. Here it is stated that preference shares were redeemed at 5% premium and debentures were redeemed at 10% premium. So 5% premium and 10% premium, that adjustment, that premium on redemption of equity share, premium on redemption of debenture, premium on redemption of preference share, that have to be taken into consideration. So this fourth additional working on additional information has various implications. First of all, we will have to redeem the preference shares. That means 50,000 preference shares will be redeemed at 5% premium. Then debentures are also being redeemed at 10% premium. 1 lakh debenture has been redeemed at 10% premium. These redemption of preference share, redemption premium on redemption of preference share and premium on redemption of debenture, that has to be shown in the profit and loss adjustment account. And similarly, there has been an issue of new equity shares, but there is also a capital reserve of 10,000. So how this capital reserve has been arrived at, that also we will have to take into consideration. So this particular problem is a very actually a comprehensive problem which has all different aspects. That means there is a change in the current assets, current liabilities, how that will be, how the impact of that will be shown in the cash flow statement. Then there is also certain sale or disposal of fixed assets. There is the provision of taxation liability, proposed dividend payment. All these are also taken into consideration in this particular problem. There is also a sale cost, investment, acquisition and sale of investment, as well as there is also be certain financial investments, certain financial activities like the redemption of preference share, redemption of debenture, and issue of new equity share. So all these additional information have to be taken into consideration. So for all these additional information, we will have to prepare the relevant ledger accounts. That means we will have to prepare an account for the equity share capital, for preference share capital, for capital reserve if it is actually required, for capital reserve, for profit and loss account, for 8% debentures. We will have to prepare these accounts. We will also prepare the account for the fixed assets, for the investments, and proposed dividend and provision for taxation. So we will have to prepare certain supporting ledger accounts. From those ledger accounts, we will get certain balancing figures. Then we will have to prepare the profit and loss adjustment account. So the after preparing all these adjustment accounts, after preparing all these additional workings, then we will go on and prepare the cash flow statement. So this is a comprehensive problem, and for solving this problem at least you will require 30 minutes to 40 minutes depending on how much you have practiced. If you have practiced very well, then you will be able to solve it within 25 to 30 minutes. But if you have not practiced that well, then you will require at least 40 minutes to solve this particular problem. So since I have already solved, I will just show straight away show how it has been solved. There has been, these are the working notes, various working notes which we have prepared, and after that we have also passed the journal entry for the issue of equity share, journal entry that has also been passed, and then we will prepare the cash flow statement. So first of all, let us focus on the journal entry. That means there has been an issue of equity share and there is also a capital reserve of 10,000. By looking at this problem, by analyzing the problem, we will find that there was a redemption of preference share capital and redemption of debenture. Redemption of preference share capital for 1 lakh, redemption of debenture for rupees redemption of preference share capital for 50,000 and redemption of 8% debenture for 1 lakh, total of 1 lakh 50,000. And then there is also an issue of equity share capital for 1 lakh 50,000. So how this capital reserve has been arrived at, that is not stated. Now this will arrive only when equity share has been issued at a premium. Equity shares, issue of equity shares at a premium. So this 10,000 is the premium at which the equity shares have been issued. 1,50,000 is the original face value and the premium is 10,000. So this premium, so what will be the journal entry that has been shown here? The journal entry is nothing but bank account debit 1,60,000 to equity share capital account 1,50,000 to capital reserve account 10,000. So this is how the capital reserve has been created due to issue of equity share, and we can show it in this manner. Now we can also assume that there has been an increase in capital reserve of 10,000, and since it is not mentioned whether capital reserve has been created by issuing equity shares or not, we are assuming that capital reserve has been created out of profit and loss account. Then the journal entry will be bank account debit to equity share capital account 1,50,000, 1,50,000, and from the general reserve of the profit and loss account we can show that capital reserve has been created. That is the profit and loss account debit to capital reserve. So we can have two type of treatments, alternative treatments, since it is not clearly stated whether the equity shares have been issued at a premium or not. So we can show this adjustment by providing or setting aside a part of the profit as capital reserve, or we can assume that the equity shares have been issued at a premium, then we will pass this journal entry. So in the both aspects, the problem will the answer will differ a bit, but the if you have explained it clearly, if you have given the logic on the basis of which you are preparing this statement, if it is clear, then you will get the full marks. So before we solve this particular problem on cash flow statement, let us focus on the profit and loss adjustment account and the various supporting ledger accounts. So first we will show this profit and loss adjustment account. We will have to show the opening balance and the closing balance. The opening balance as per the net profit as per this given in this particular problem. Opening balance is 1 lakh and closing balance is 2 lakh. Just looking at this problem, you will find that profit and loss account opening balance is 1 lakh and closing balance is 2 lakh. So we are preparing this profit and loss adjustment account, and we have already shown the opening balance 1 lakh and closing balance 2 lakh. Profit and loss account, profit and loss account opening balance is 1 lakh and closing balance is 2 lakh. Now we will solve the ledger accounts one by one. First of all, we are showing the fixed assets account, provision for depreciation account, and asset disposal account. So fixed asset account, opening balance of fixed asset and closing balance of fixed asset. Fixed asset is opening balance is 10 lakh, closing balance is 12 lakh. Provision for depreciation, opening balance is 2 lakh and closing balance is 2 lakh 50,000. So fixed asset opening balance is 10 lakh, closing balance is 12 lakh, and provision for depreciation opening balance is 2 lakh, by balance BD 2 lakh, and closing balance is 2 lakh 50,000. To balance CD 2 lakh 50,000. Now we are also preparing one asset disposal account. Asset disposal account. So what is the asset disposal account? We are given in this particular problem. We are stated that book value of the fixed assets is 10,000 and depreciation written off is 30,000. So the value of the asset, the original asset cost was 10,000 plus 30,000, 40,000. So that is the original cost of the asset. So in the asset disposal account, we will write two fixed assets account, cost of the asset 40,000, by provision for depreciation account 30,000, provision for depreciation 30,000. So these two fixed assets account 40,000, that is again shown in the fixed assets account by asset disposal account 40,000, because this particular fixed asset is being disposed of. That is why this fixed asset balance will have to be shown in the credit side by asset disposal account 40,000. After that, these particular fixed assets have been sold for 8,000. These particular fixed assets have been sold for 8,000. So these fixed assets have been sold for 8,000. So we are stating here by bank account, sale of fixed assets 8,000, and we are getting a loss by profit and loss adjustment account, loss on sale of 2,000. So we are first of all preparing this asset disposal account. The cost of the asset is fixed asset is 40,000. Provision for depreciation already made into this particular fixed assets is 30,000. The asset has been sold for 8,000 and there is a loss on sale of 2,000. So we are passing all these entries. We are passing all these entries in the ledger account, and we are closing the asset disposal account. Now, after closing the asset disposal account, we will also have to close the provision for depreciation account, because the provision for depreciation 30,000 has to be written back. Has to be written back. So that is why provision for depreciation opening balance was 2 lakh, closing balance was 2 lakh 50,000, and these 30,000 provision for depreciation has been written back. So provision for depreciation account debit to asset disposal account 30,000, to asset disposal account 30,000. So what is actually the provision that has been created for this particular year? For this particular year, provision created is shown in the balancing figure. So by profit and loss adjustment account, depreciation, provision for depreciation created during this year, this is nothing but this 2,80,000, 2,50,000 plus provision for depreciation written back of 30,000, 2,80,000 less 2 lakh, less 2 lakh. So by profit and loss adjustment account 80,000, by profit and loss adjustment account 80,000. These 80,000 will again be shown in the profit and loss adjustment account. to depreciation, profit and loss adjustment account to depreciation account. Provision for depreciation, that is 80,000. So again to depreciation 80,000. So we are also passing it in the profit and loss adjustment account to depreciation 80,000. Now, after we have closed this asset and disposal account, in the asset and disposal, we are also getting a loss on sale. So this loss on sale have to be shown in the provision for profit and loss adjustment account to loss on sale 2,000, to loss on sale 2,000, to depreciation 80,000, and to loss on sale 2,000. We have shown it both these entries in the profit and loss adjustment account. Now, after we have closed this provision for depreciation and asset disposal account, we will now close the fixed assets. Fixed assets opening balance was 10 lakh, closing balance 12 lakh, and asset disposal, that is 40,000. So 12 lakh 40,000 less 10 lakh. So balancing figure is to bank account 2 lakh 40,000. So there is a new purchase of fixed asset of rupees 2 lakh 40,000 that has to be shown in the cash flow statement as an investing activity. This will be shown as an investing activity. Fixed assets to bank account purchase of 2,50,000 will be shown as an investing activity. And in the asset disposal by bank account sale of assets 8,000, that will be shown as a cash inflow from investing activity. Now we will focus on the provision for taxation. In case of provision for taxation, if we analyze the problem, we will find that the opening balance of provision for taxation is 70,000. Closing balance is 75,000. So opening balance is 70,000. Provision for depreciation, provision for taxation, opening balance is 70,000 and closing balance is 75,000. Now, taxes paid during the year, it is shown in the additional information. Taxes paid during the year shown in the additional information, that is 55,000. Taxation liability was settled at 55,000. So taxation paid, that means that is the payment. So to bank account, provision for taxation to bank account, taxes paid 55,000. So what is the closing balance? The closing balance is nothing for 55,000 plus 75,000 less 70,000. So 1 lakh 30 less 70,000. So 60,000. So 60,000 is what? That is the provision for taxation which has been created during this year. Provision for taxation of 60,000 has been created during this year by profit and loss account adjustment 60,000, and this particular provision for taxation will again be shown in the profit and loss adjustment account to provision for taxation 60,000, to provision for taxation 60,000. That is again shown here. Next we will close the proposed dividend account. Proposed dividend.
Uh,
Okay.
excuse me, sir. I have one question in this.
Yes, yes.
Sir, if the question is silent about the payment of taxes, then I
Yes.
think the opening balance will come to the payment part and the
Yes.
closing balance will go to the PL part, right, sir?
Exactly. If the
Okay,
problem
okay.
is silent in case of provision for taxation proposed dividend, we may assume whatever is the opening balance of provision for taxation or the
Hmm,
opening balance
hmm,
of the proposed dividend, that actual
hmm.
amount has been paid during the year. That will be,
Okay,
that
okay.
we can assume, and that we can show as to bank account that particular opening balance. Like in this case of
Yes.
proposed dividend, you will find that the problem is silent in this
Hmm,
particular problem. The problem is silent. The dividend proposed in last year was paid, only this much has been stated. So that is why
hmm.
whatever is the opening balance that is being paid, proposed dividend by balance brought down 30,000 and to bank account 30,000. The actual amount is the opening balance that is being paid during the year.
Yes, sir.
Whatever is the closing balance, adjustment is being made for that particular figure. That means by profit and loss
Yes, sir.
adjustment account 35,000. Very good question. So if the problem is
Okay.
silent, suppose in case of additional information nothing is stated, in additional information nothing is stated, then we can straight away assume that whatever is the opening balance of the proposed dividend or provision for taxation, that opening balance is being paid during the year as the taxes paid or the dividend paid during the year. and whatever is the closing balance, that has been provided for in the profit and loss adjustment account. So this is the general logic. But in case of these problems, since the taxes paid is differing, so we are actually preparing this ledger account, and we are finding out, ascertaining that the profit and loss adjustment account, that is the provision for taxation which has been created, is 60,000. So in this way, we will close these two accounts, provision for taxation account and proposed dividend account. And we will have to be very careful that to bank account taxes paid 55,000. This will come under the operating activities. But to bank account 30,000 proposed dividend, this will come under the financing activities. This is actually the cash flow under the financing activities, and provision for taxation, taxes paid, is actually the cash outflow under the operating activities. Now,
Yes, sir.
for simplicity, or for so that we can ascertain properly, I have just highlighted these two bank account in yellow because this deals with the cash flow statement, and this by this light blue or the light green, whatever you state, this particular color I have highlighted, this deals with the profit and loss adjustment account. So all these things which deals with the profit and loss adjustment account must be shown in the profit and loss adjustment account. And the profit and loss adjustment account, the opening balance of profit and loss adjustment account was 1 lakh, and the closing balance is 2 lakh. However, there is also one general reserve and one capital reserve. So general reserve has increased by 50,000 and capital reserve has increased by 10,000. And that is why in this profit and loss adjustment account, to general reserve 50,000 and to capital reserve 10,000 is already shown. To general reserve 50,000, to capital reserve 10,000 is already shown. Furthermore, we have shown the various depreciation, loss on sale, provision for taxation, and to propose dividend 35,000. We are showing these three accounts since we have prepared them. Now we will prepare the redemption on debenture. We will prepare the premium on redemption of debenture, that is the debenture and preferential redemption. We will prepare the ledger accounts of both these accounts, and we will ascertain what is the premium that has been paid on this redemption of debenture and this redemption of preferentials. But we will also find that in the balance sheet, miscellaneous expenses 15,000, from that 15,000 it has reduced to 10,000. Miscellaneous expense is nothing but a fictitious assets that is written off every year. Certain amount is written off every year. So by analyzing this particular balance sheet, we can straight away assume that miscellaneous expenses of 5,000 have been written off during the year. Miscellaneous expenses, since it has reduced from 15,000 as on the opening date to 10,000 as on the closing date. So that is why 5,000 miscellaneous expenses have been written off. So we will also keep in mind that we will, of course, show this return of miscellaneous expenses of 5,000 in the profit and loss adjustment account. To miscellaneous expenses return of 5,000, we are again showing it in this profit and loss adjustment account. And before we move to the cash flow statement, we will just solve this preferential capital, debenture, and investment what have been sold and purchased. So investment is very simple because the investment opening balance was 1,80,000 and closing balance was also 1,80,000. And during the year, investment costing 80,000 were sold and investment of the same cost were purchased. That means there was neither any profit nor any loss. So simply we are preparing this investment account. Opening balance of this investment account is 1,80,000. Closing balance is again 1,80,000. Purchase of 80,000 was made during the year and sales at cost of 80,000 was made during the year. So that is why this investment account, from this investment account, we are only able to know that means there was an in cash inflow, increase in the cash because there was the sale of investment for 80,000. There was also a cash outflow, that means there was purchase of investment for 80,000, but there was neither any profit nor any loss. Now we will focus on the critical aspect, that is the redemption of preferential and redemption of debenture, before we go on to the next part, that is the cash flow statement. So far as the redemption of preference share is concerned, we will first of all prepare the preference share capital account. Preference share capital account, opening balance is 51 lakh and closing balance is 50,000. Similarly, we will also prepare the 8% debenture account. 8% debenture is opening balance is 3 lakh and closing balance is 2 lakh. So first of all, we will open these accounts. We will open these accounts. Preferential capital by balance brought down 1 lakh to balance carried down 50,000, and 8% debenture by balance brought down 3 lakh and to balance carried down 2 lakh. So this is given in the problem. Along with this, we will also prepare the equity share capital account. Equity share capital account, opening balance was 5 lakh and closing balance was 6 lakh 50,000, since it was also given in the problem. Equity share capital, opening balance 5 lakh and closing balance 6 lakh 50,000. Now one by one, we will solve it logically. First of all, we will focus on the premium on redemption of preference share. Now redemption of preference share, amount that has been redeemed is 50,000. Amount that is being redeemed is 50,000. Preference share capital 1 lakh, and that is 50,000, but the amount redeemed is 50,000. So on this 50,000, 5% premium. So 5% of this 50,000 is 2,500. 2,500. So premium on redemption of preference share capital is 2,500. So premium on redemption of preference share to preference share capital account 2,500. That has to be shown, 2,500 premium on redemption. Again, we will have to pass it in the profit and loss adjustment account. Profit and loss account debit to premium on redemption 2,500. 2,500 premium on redemption of preference share capital. Now there is again one more premium, that is the redemption of debenture, that we will come into that later on. So first premium on redemption is 2,500. So that is why our balance is 1,02,500 and closing balance is 50,000. So actual preference share redemption is being made for 52,500, because the journal entry is like this: preference share capital account debit 50,000, premium on redemption of preference share capital 2,500, to bank account 52,500. So that is why premium on redemption, first of all, we are creating it on at the rate of 5% of 50,000, so 2,500, and we are paying the amount 52,500. That is the preference share redeemed. Preference share redeemed is 52,500. Similarly, in case of 8% debenture, debentures redeemed is book value is 1 lakh, because the opening balances was 3 lakh and closing balance is 2 lakh. So debenture redeemed, the book value is 1 lakh, but there is a premium at the rate of 10%, which is shown in, which is given in the problem. In the problem, it is stated that debentures were redeemed at 10% premium. Debentures were redeemed at 10% premium. So if the debentures are redeemed for 1 lakh, then at 10% premium, 10,000 will be the premium amount. 10,000 will be the premium amount. That is why here, first of all, we are creating this premium by premium on redemption of debenture 10%. So that is 10,000. So that is 10,000. And to bank account, so what is the journal entry? Journal entry is 8% debenture account debit 1 lakh, premium on redemption of debenture account debit 10,000, to bank account 1 lakh 10,000. So that is why to bank account 1 lakh 10,000. This is actually the redemption value 1 lakh 10,000. So premium on redemption of preference share is 2,500 and premium on redemption of 8% debenture is 10,000. That is why the total to premium on redemption of 12,500 is shown in the profit and loss adjustment account. Profit and loss adjustment account, it is 12,500. So we have closed this preference share capital account and we have ascertained that the preference shares were redeemed for 52,500. We have closed these 8% debentures and we have ascertained that these 8% debentures were redeemed for 1,10,000. Now we will close the equity share capital account. Equity share capital account, 5 lakh was the opening balance and 6,50,000 was the closing balance. So we are stating that by bank account 1,50,000, issue of equity share 6,50,000. Now we could have also treated this capital reserve with this equity share capital, and it would have been equity share capital bank account debit to equity share capital account to capital reserve account. That could have been an alternative treatment. But since it is not, the problem is not clear whether the equity shares have been issued at premium or not, we have straight away shown it as a profit that has been set aside from the profit and loss adjustment account. So profit and loss adjustment account debit to capital reserve account. So in this way, first of all, we will solve the ledger accounts. We will close all the ledger accounts and find the various balances, the closing balances. We will find both the cash inflow and our cash outflow from by closing the ledger accounts, and we will also find that there are certain aspects that means there are certain treatment which has to be shown in the profit and loss adjustment account, that is also arrived at as a balancing figure by closing these ledger accounts. So by closing all these ledger accounts and by closing the profit and loss adjustment account, we are getting an operating profit of 3,54,500. 3,54,500 we are getting an operating profit. So now we will go and prepare the cash flow statement. Cash flow statement of Symphony Limited as on 31st March 2021 as per Ind AS 7 under the indirect method. First of all, cash flow from operating activities, operating profit before working capital changes, which we have arrived at by this profit and loss adjustment account, that is 3,54,500. 3,54,500. Now there has been increase in current liabilities. Increase in current liabilities during the year 10,000 to 12,000 and 1,60,000 to 2,50,000. Since increase in current liabilities have a direct relationship with the increase in the cash flow. That means if the current liabilities increases, cash flow will also increase. If current liability decreases, cash flow will decrease. But increase in current assets have a negative impact. If the current assets increases, cash flow will decrease. If the current assets decreases, cash flow will increase. So that is why increase in current liabilities 10,000 to 12,000 and 1,60,000 to 3,50,000. That means um, shown here. Increase in liabilities, increase in creditors for expenses of 2,000 and increase in creditors for goods of 90,000. So these 92,000, this increase in current liabilities is resulting in an increase in current assets. That is why we are adding them. We are adding them and we are getting 3,54,000 plus 92,000, 4,46,500. An increase in current assets leads to decrease in the cash flow. So that is why we are deducting increase in current assets, increase in stock 50,000, increase in debtors 40,000, increase in bills receivable 24,000, increase in prepaid expenses 3,000. How we are arriving at this figure? Because in the particular problem in the balance sheet only it was stated that stock 50,000 has increased 2 lakh to 2 lakh 50, debtors 2 lakh 25 to 2 lakh 65, 40,000. Bills receivable 38 to 62, that means 24,000, and prepaid expenses 2,000 to 5,000, that is 3,000. So all these increasing current assets that is being deducted 50,000, 40,000, 24,000 and 3,000, total of 1,17,000. So this 1,17,000 is deducted from this 4,46,500, and we are arriving at the net cash flow from operating activities before taxes, that is 3,29,500. Now in the given problem, taxes paid is 55,000. Taxes paid is 55,000. Opening balance was 70,000, closing balance was 75,000. However, the taxes paid during the year, taxation liability was settled for 55,000. 55,000. So taxes paid is 55,000. So these taxes paid will have to be deducted. So after deducting these taxes paid 55,000, after deducting this, we are getting the net cash flow from operating activities, that is 2,74,500. 2,74,500. Now we will prepare the cash flow from investing activities. Now in case of investing activities, we had already prepared these accounts, fixed assets account and asset disposal account. In the asset disposal, we found out that there was a sale of asset for 8,000, and in the investment account we found out that there was a sale of investment for 80,000. So we have two types of sales. So in the fixed assets, sale of fixed assets 8,000 and sale of investments 80,000. And again in the fixed assets account we have found out that there was a purchase of fixed assets for 2,40,000, and from the investment account we also found out that there was a purchase of investment for 80,000. So we are also stating that there was a purchase of fixed assets for 2,40,000 and purchase of investments for 80,000. Apart from this, there were no other cash flow from investing activities. So the total of cash inflow is 88,000 and the total of cash outflow is 3,22,000 20,000. So the resultant figure is net cash flow from investing activities. It is 2,32,000 negative balance. 3,20,000 less 88. So 2,32,000 negative balance, that is shown within the bracket. Finally, we will have to write the cash flow from the financing activities. In case of cash flow from financing activities, there has been a issue of equity share capital for 1,50,000, redemption of preference share capital for 52,500, redemption of debenture for 1,10,000, and there was also dividend paid since nothing is stated. So the opening balance, that is 30,000, that is the dividend paid. So dividend paid is 30,000. So all this we will show in the cash flow from financing activities. Equity of share capital 1,50,000, redemption of preference share capital 52,500, so that is negative, shown within bracket. Redemption of 8% debenture 1,10,000, that is also a cash outflow, shown within bracket. And payment of proposed dividend 30,000, that is also cash outflow, shown within bracket. So 1,50,000 less the sum of these three, and we are getting the net cash flow from financing activities 42,500. So after we have obtained this net cash flow from operating activity, net cash flow from investing activities, and net cash flow from financing activities, 2,74,500 less 2,32,000 less 42,500, resultant figure is nil. That is net cash increase or decrease in cash and cash equivalents is nil. And now with this we will add the opening cash and cash equivalents. Opening cash and cash equivalents, that is shown in the balance sheet, that is 10,000, and closing cash and cash equivalents is also 10,000. So with this we add the opening cash and cash equivalents 10,000, and we are arriving at the closing cash and cash equivalents of 10,000. So in this way we will be solving a problem on cash flow statement and the indirect method. Now if any of the student who have joined, do you have any other query regarding this solution?
Sir, one more query is there.
Yes.
In the asset side, I have seen that there is one just below miscellaneous expenditure.
Yes.
There is one, I think, prepaid expenses is there.
No. Yes. Prepaid
Balance
expenses.
sheet.
Yes. Prepaid expenses.
Expenses there.
Yes. Prepaid expenses has already been treated in the current assets part.
Yes, sir. I mean, like in some of the books, I have found that it has been treated in the PL account, not in the asset side. So which one is correct, sir?
Prepaid expenses, PL account, if PL account is given, that means PL account has to be written off. If the PL account balance is given, that means profit and loss, there was certain loss. So that loss may
Yes.
be adjusted. So PL account debit balance and PL account credit balance, you can show it in the profit and loss adjustment itself. That means the profit and loss adjustment, suppose there was the opening balance is the net profit and the closing balance is net loss. So one way of treating it is by showing it in the PL adjustment account. And if the PL
Correct.
adjustment account is in the nature of a fictitious asset like miscellaneous expenses, suppose that loss has to be written off year by year, then that will have to be written off year by year, certain manner that will be either stated in the problem or it will be, we can assume it. But generally if there is a net loss, then we can show it in the profit and loss adjustment account, that is opening balance of, let's say it is net profit and closing balance is net loss, then we will show it in the as the net loss in the profit and loss adjustment account itself.
Okay. Then this we need to show it into current asset part
Yes,
and in part of working capital adjustment.
yes.
Okay. Okay.
Now,
Okay.
very important thing is to be noted is that we are preparing these operating activities, investing activities, financing activities from the viewpoint of a trading enterprise, on a manufacturing enterprise, or from a grocery shop or retail shop, in that manner. But in case of a banking enterprise or banking and financial institution, they deal with these short-term deposits, accounts, current accounts, ledger accounts, and so on. That is why in their case, interest received, dividend received, or any kind of savings account liabilities, they are all their operating activities. So we will have to be very careful if it is in case of a banking and financial institution, any kind of interest received, dividend received, or say accounts opened, liabilities, loans given or received, loans, that is the redemption of loan or repayment of loan, all these will come under the operating activities head. All these will come under the operating activities head, that we will have to be very very careful if it is the in case of a banking or a financial institution. Then the nature of these operating activities will change, if because their main activity is dealing with this provision of loan, receipt of interest, payment of interest, and then various types of savings current account, etc., opening of the savings current account, and their timely repayment. All these will come under the operations part. So in their case, the whether whatever we are treating as the financing activities, that is the interest paid, dividend paid, or say under the dividend received, interest received, under the investment activities, that will all come under the operating activities in case of a banking and financial institution. So that we will have to be careful while preparing the cash flow statement. We will first of all have to know whether the particular firm is a trading enterprise, manufacturing, retail enterprise, or whether it is a financial enterprise. And one more thing, that is the disclosure requirement as per Ind AS 7. Yes, reporting cash flows from operating activities. This Ind AS 7 para 18, it states that an entity shall report cash flows from operating activities using either the direct method, whereby major classes of gross cash receipts and gross cash payments are disclosed, or the indirect method, whereby profit or loss is adjusted for the effects of transactions of a non-cash nature, any deferrals or accruals of past or future operating cash receipts or payments, and items of income or expense associated with investing or financing cash flows. That means the Ind AS 7 is clearly stating, that means cash flow statement may be prepared either under the direct method or the indirect method, depending on the information we have in our hand. If we have information regarding all the major classes, gross cash receipts and cash payments, we can prepare it under the direct method. And if we do not have that complete information, we can prepare it under the indirect method. And one more thing we will have to be careful is that the cash flows from the investing and financing activities, that is cash flows arising from the following operating, investing, and financing activities, may be reported on a net basis. Cash receipts and payments on behalf of customers, when the cash flows reflect the activities of the customers rather than those of the entity. And cash receipts and payments for items in which the turnover is quick, the amounts are large, and the maturities are short. So in this case, it may be reported on a net basis. That means we won't have to give the all the details, but on the net basis only we can show the cash receipts and the cash payments. And similarly, cash flows arising from each of the following activities of a financial institution may be also reported on a net basis. That is the cash receipts and payments for acceptance and repayment of deposits with a fixed maturity date, placement of deposits with and withdrawal of deposits from other financial institutions, and cash advances and loans made to customers and the repayment of those advances and loans. And one more thing, this is about the foreign currency cash flows. Cash flows arising from cash transactions in a foreign currency shall be recorded in an entity's functional currency by applying to the foreign currency amount the exchange rate between the functional currency and the foreign currency at the date of the cash flow. So on the date the particular transaction has occurred, on that particular date, what is the foreign currency, the conversion that has to be applied, foreign exchange rate that has to be applied, and then the cash flows arising from transaction in the foreign currency will be recorded. Similarly, cash flows of a foreign subsidiary shall be translated at the exchange rates between the functional currency and the foreign currency at the dates of the cash flows. So these are some minor points. These are some fine points which have to be remembered while preparing the cash flow statement. And whatever the thing I was stating, it is all stated in the para number 31 of Index 7, that is cash flows from interest and dividends received and paid shall each be disclosed separately. Cash flows arising from interest paid and interest and dividends received in case of a financial institution should be classified as cash flows arising from operating activities. In the case of other entities, cash flows arising from interest paid should be classified as cash flows from financing activities, while interest and dividends received should be classified as cash flows from investing activities. Dividends paid should be classified as cash flows from financing activities. So para 31, we will have to be very careful while preparing the cash flow statement, and we will have to take into consideration the para 31 so that our problem is correctly solved. So this is all about the cash flow statement. Then taxes on income also, it have to be separately disclosed. Then whether there is any change in ownership interest in subsidiaries and other businesses, that has also to be separately shown and disclosed. So this is all about the cash flow statement. And Index 7. So students must refer to this Index 7 if they face any problem while solving the cash flow statement. So this is all from my part. So if there is any other query, students can refer to me, or can also post their queries in the YouTube. Then we will be giving them the solutions through mail or any other platform that our society decides. So Ronak, that is all from my part. Thank you so much. Thank you so much. Thank you, everyone. Good night.